You just told your sons you are a fraud. The words are still in the air. Your wife is standing by the window. Your sons are looking at you the way people look at a stranger. You have $65 billion of other people's money, and every statement you have ever sent them was fiction. 17 years. The number sits in the room like something physical. 4,200 clients, charities, pension funds, Holocaust survivors, your closest friends, your own family. All of them holding account statements that have never once described anything real. It is the evening of December 10th, 2008. The apartment is quiet, and you have just said the words out loud for the first time in your life. Let's go back to the beginning. Because to understand how a man runs the largest fraud in financial history for 17 years without being caught, and then walks into his sons' lives and hands them a grenade, you have to understand how the lie was built and how carefully it was made to look like the truth. Bernard Lawrence Madoff, born 1938 in Queens, New York. Son of a plumber's daughter and a hardware man, neither of whom made much of anything financially. He was not born rich. He started with $5,000 saved from working as a lifeguard and installing sprinkler systems, and in 1960 he used that money to found a penny stock brokerage in his father-in-law's accounting offices. The firm was called Bernard L. Madoff Investment Securities. It was real. The trading operation, the market-making business, the technology, all of it legitimate and genuinely excellent. By the 1980s, his firm was helping to build NASDAQ. By the early 1990s, he served as the exchange's chairman. On Wall Street, Bernie Madoff was not a fringe figure. He was an architect. The second part of his business, the asset management arm, the quiet one, was something else entirely. He never advertised it. You didn't find Bernie Madoff. Bernie Madoff found you. The accounts were exclusive, whispered about at country clubs in Palm Beach and the Hamptons, passed between friends like a gift that only the right people received. Steven Spielberg invested. The foundation of Eli Wiesel invested. Banks, hedge funds, charities across Europe and the United States channeled client money into his fund through what were called feeder funds, investment vehicles that existed purely to route money to Madoff and collect a fee for doing so. Nobody asked too many questions. That was the etiquette of the thing. The returns were not spectacular. That was the genius. 10 to 12% annually, year after year, with almost no volatility. While the market soared in the 90s, Madoff's clients made steady, consistent gains. When the market crashed in 2000 and 2001, Madoff's clients still made steady, consistent gains. Not 20%, not 50%, just quiet, reliable 10% every year, regardless of conditions. The consistency was the con. It was calibrated precisely to be too good to be plausible, but not so good that it triggered disbelief. On the 17th floor of the Lipstick Building in Midtown Manhattan, the actual investment operation was run out of a separate floor, the 19th, that almost nobody from the firm was allowed to enter. Frank DiPascali, Madoff's chief lieutenant, managed the fabrication from there. No actual trades were being made. The client statements were printed on specially ordered paper. The account numbers, the trade confirmations, the tax documents, all of it produced in-house on paper that looked exactly like the paper that real brokerages used. When the SEC came to investigate, and they came 5 times between 1992 and 2007, Madoff met with them personally. Charming, precise, unhurried. Each time, they left satisfied. The fraud that was hidden in plain sight on a separate floor in a firm run by the former chairman of NASDAQ. He kept it going the only way a Ponzi scheme can be kept going, by growing. New money from new investors paid the returns, owed to existing ones. As long as more came in than went out, the machine ran. For 17 years, it ran. Then came 2008. In September, Lehman Brothers collapsed. The financial crisis shook every major institution. Investors across the board panicked and began pulling their money from everything. Between September and December of 2008, Madoff's clients requested approximately $7 billion in redemptions, withdrawals of money they believed was theirs, sitting in accounts fully invested. There was $300 million in the account, against $7 billion in requests. The paper value of all his accounts was $65 billion. None of it existed. He called in favors. He reached out to friends, to banking contacts, to anyone who might inject capital. Carl Shapiro, his oldest friend in the world, sent him $250 million in November 2008. It wasn't enough. On December 3rd, Madoff pulled Frank DePascali aside in the office. He said 5 words: "I am out of money." He was not panicking. That is the part that still unsettles people who study this case. He was not frantic or desperate in the way you might expect. He had been running this since the early 1970s. Some evidence suggests as far back as that, though Madoff himself later claimed it began in the early 1990s. However long it had run, he had known all along that it would end this way. A Ponzi scheme has only one ending. He had lived in the gap between knowing that and not being there yet. Now, he was there. He held the firm's annual Christmas party on December 10th. He handed out early bonuses to staff. He was relaxed. He had already decided what he was going to do. He had told DePascali to use the remaining $234 million to pay out favored clients and family members. The last acts of a man distributing what was left before the building came down. His sons, Mark and Andrew, both worked for the firm in the legitimate trading side. They had grown concerned over the previous weeks about the redemption requests and the way their father had been responding. That afternoon, they confronted him. If the business was struggling to meet client withdrawals, how was he able to pay staff bonuses early? It was a simple question, the kind that cuts through everything. He said, "Let's go to the house and talk." They went to his apartment on East 64th Street. Ruth Madoff was there. And in that apartment on the evening of December 10th, 2008, Bernard Madoff told his sons and his wife that his investment business was, and he used these exact words, one big lie. He said he had absolutely nothing left. He said he had planned to wind things down over the coming week and then have his sons turn him in. He wanted a few more days. His sons walked out of the apartment and called a lawyer. The lawyer called federal prosecutors. They did not give him his week. The following morning, December 11th, 2 FBI agents knocked on the door of Madoff's penthouse. They told him they were there to find out if there was an innocent explanation. Madoff looked at them and said, "There is no innocent explanation. I've been running a massive Ponzi scheme." He was arrested at 8:30 in the morning. He was 70 years old. The aftermath unspooled across years. Madoff pleaded guilty on March 12, 2009, to 11 federal felonies: securities fraud, wire fraud, mail fraud, money laundering, perjury. He was sentenced to 150 years in prison, effectively every remaining year of his life, multiplied by 2. The judge called it unprecedented in the history of financial crime. The losses were almost impossible to comprehend. The $65 billion figure represents the total claimed value of all client accounts. The actual cash deposited was approximately $17.5 billion. Trustee Irving Picard spent a decade clawing back money from feeder funds and banks that had looked the other way. By 2021, when Madoff died in federal prison in Butner, North Carolina at 82, Picard had recovered approximately $14.5 billion, roughly 70% of direct losses. No number accounts for the charitable foundations that dissolved, the retirees who lost everything, or the Elie Wiesel Foundation, which lost $15.2 million. Its entirety. Harry Markopoulos, a financial analyst from Boston, had submitted detailed reports to the SEC in 2000, 2001, and again in 2005, arguing mathematically that Madoff's returns were impossible. His 2005 submission was titled, "In Full, The World's Largest Hedge Fund is a Fraud." It ran to 19 pages. The SEC did not act on it. The personal wreckage ran alongside the financial one. Mark Madoff, the elder son who had walked out of his father's apartment and made the call that ended it, died by suicide on December 11, 2010, exactly 2 years to the day after his father's arrest. He was 46 years old. Andrew Madoff, the younger son, died of cancer in 2014 at the age of 48. Ruth Madoff, who surrendered most of the couple's assets as part of a settlement, was left with $2.5 million and the knowledge of what she had been married to. Madoff, interviewed from prison in his final years, never fully explained why. Not the real why. He talked about client expectations, about how the fraud grew incrementally, about how he always meant it to be temporary. He said he believed some banks and feeder funds had to know what he was doing and chosen not to look. He expressed regret. With the same precision and control that had kept the lie running for 17 years. The thing about Bernie Madoff that separates him from almost every other fraudster is that he confessed voluntarily, not to regulators, not to prosecutors, to his sons. On a Wednesday evening in December, in his apartment, in the middle of a financial crisis that had made the numbers impossible, he had run out of options, out of money, and he chose to walk into the room and say the words. Not because he was caught, because there was nothing left to do except say them. He described his own investment fund to the two men who had spent their careers inside his firm and who trusted him completely as one big lie. It had taken him 17 years to say it. It took his sons about 2 hours to call a lawyer who called federal prosecutors who did not give him his week.